Key mistakes to avoid with exchange-traded funds, ETFs. Exchange-traded funds, ETFs, have become a popular investment vehicle, offering diversification and ease of trading. However, like any investment, there are potential pitfalls. Avoiding common mistakes can significantly improve your potential investment outcome. The following are key mistakes to steer clear of. 1. Neglecting research and due diligence. Not understanding what's inside. Exchange-traded funds can track a vast array of indexes, sectors, geographies, or investment strategies. It's crucial to understand the exchange-traded fund's underlying holdings and how it achieves its investment objectives. Don't assume an ETF is diversified or fits your goals simply because of its name. Ignoring the index for passive ETFs. For passively managed ETFs, understand the index it aims to replicate. Some indexes are better constructed and more representative than others. A poorly constructed index can lead to undesirable exposures or concentrations. Chasing past performance. An ETF's strong past performance doesn't guarantee future success. Market conditions change and hot trends can cool. Focus on the ETF strategy, holdings, and suitability for your long-term goals. Overlooking ETF structure. Be aware of the exchange-traded fund's structure, such as unit investment trust versus open-ended fund, as this can have implications for reinvestment of dividends and tracking. 2. Disregarding costs and fees. Ignoring expense ratios. While ETFs are often lauded for low costs, expense ratios vary. Even seemingly small differences in expense ratios can significantly impact long-term returns. Compare the expense ratio to similar ETFs. Overlooking trading costs. Frequent trading of ETFs can rack up brokerage commissions. Though many brokers offer commission-free ETF trading, be mindful of other potential costs like payment for order flow. Additionally, consider the bid-ask spread, which is the difference between the buying and selling price. This spread can be wider for less liquid ETFs, increasing your trading costs. 3. Misunderstanding and mismanaging risk. The illusion of diversification. While ETFs offer diversification, holding multiple ETFs that have overlapping underlying assets doesn't necessarily mean you're well diversified. You could still be overly concentrated in specific sectors, industries, or a few large cap stocks. Concentration risk. Many ETFs focus on specific sectors, industries, or asset classes. This can be beneficial if that sector performs well, but it also ties your investment heavily to the fortunes of that particular area, increasing risk. Underestimating market risk. ETFs are subject to market fluctuations. The value of your ETF can go down as well as up, depending on the performance of its underlying assets. Investing in leveraged or inverse ETFs without fully understanding. These are complex financial instruments designed for short-term trading by experienced investors. They can experience significant losses due to their daily rebalancing and the effects of compounding, especially in volatile markets. They are generally not suitable for long-term buy and hold investors. 4. Poor trading practices. Trading too frequently, overtrading. Trying to time the market by frequently buying and selling ETFs can lead to higher transaction costs, potential tax inefficiencies, and can detract from a long-term investment strategy. Ignoring liquidity. ETFs with low trading volume, low liquidity, can have wider bid-ask spreads, making it more expensive to buy and sell. It can also be harder to sell your shares quickly at your desired price. Check an exchange-traded fund's average trading volume. Trading during volatile market times. The opening and closing minutes of the trading day can sometimes see wider spreads and more price volatility. Not using appropriate order types. Understand the difference between market orders and limit orders. Market orders execute at the best available current price, which can sometimes be unfavorable in fast-moving or illiquid markets. Limit orders allow you to set a specific price at which you're willing to buy or sell. 5. Neglecting portfolio management and strategy. Lack of a clear investment plan. Investing in ETFs without a broader investment strategy and defined financial goals can lead to a haphazard portfolio. Not monitoring or rebalancing your portfolio. Periodically review your ETF holdings to ensure that they still align with your investment objectives and risk tolerance. Rebalance if your asset allocation has significantly drifted. Emotional investing. Making investment decisions based on fear, greed, or chasing hot trends can lead to poor outcomes. Stick to your long-term plan. Misinterpreting tracking error and tracking difference. Tracking error, this measures the volatility of the difference in returns between the ETF and its benchmark index. Tracking difference, this is the actual difference in performance between an ETF and its underlying index over a specific period. It's impacted by fees, transaction costs, and the fund's replication strategy. While some tracking difference is expected due to expense ratios, a consistently large or erratic tracking error difference warrants investigation. 6. Tax inefficiency. Less common with ETFs, but possible. While ETFs are generally more tax efficient than mutual funds, be aware of potential capital gains distributions, especially for actively managed ETFs or those that undergo significant rebalancing. Understand the tax implications in your specific jurisdiction. By being aware of these common mistakes, investors can make more informed decisions when incorporating exchange-traded funds, ETFs, into their portfolios and increase their chances of achieving their financial objectives. Thank you.